Was capital affected? No. Now this is where a lot of people get confused. Remember, if capital shows us how much of the assets belong to the owner, in this case, did our total assets go up? Not really. Look, our cash went down, which is an asset, $3,000, but office equipment went up $3,000. So we actually had a net zero gain in our assets. We spent $3,000 of one asset, so the cash went down, to buy another one that was worth $3,000. So they balance each other out, so our owner's equity or capital actually doesn't get affected in this one. And there's no change to the right side of the accounting equation. Alright, so let's take a look at the balances. Now we have $22,000 in cash, $3,000 still in computer equipment, we just bought some, still $400 in office equipment, delivery's not affected, we didn't take out any loans, and our capital is still $25,400, right? So when we add these all up, $22,000 plus $3,000 plus $400, we have $25,400, and we're still in balance. All of our assets, the total of our assets, still equals our liabilities plus owner's equity. Alright, let's keep going. Last transaction that we're going to do. Transaction number 4. Zip bought a used truck on account. Oh boy, here we go. New word, on account. On account is what I like to call a trigger word. Anytime you hear on account, you need to think, is it accounts payable or accounts receivable? Who owes the money? Do we owe somebody money or does somebody owe us money? That's what we have to think about anytime we see on account. And it's either going to be accounts receivable affected if we're waiting to receive the money, or it's going to be accounts payable if we're the ones who are going to pay people later. So on account is when the business buys an item on credit. So let's see. What are we doing here? Zip bought a used truck. So we bought a used truck on account from Coast to Coast Auto for $12,000. So which accounts would be affected? What did we buy first of all? We bought a truck. So if you look at the categories, I would say a truck is pretty much delivery equipment, right? If we're in the delivery business, we need something to deliver our goods. We would say the delivery equipment truck would be part of delivery equipment. And the value of it, now we have a truck that's worth $12,000. So we have to increase the account $12,000. So we would add $12,000 to our delivery equipment. But because it's on account and we owe Coast to Coast Auto $12,000, did we pay our own money or did we take out a loan to get that $12,000? We took out a loan basically because we have to pay them back. We call that a liability. So the account that would be our liability account is accounts payable. And did the amount of money that we owe them increase? Absolutely. We owe those people $12,000. So we have to increase our liability $12,000 to show that now we have an increase in the amount of money that we owe. Alright? Owner's equity doesn't get affected because if we were to sell that truck tomorrow, we wouldn't get any of the money from it. It would all go back to the person that we owe. Or it would go back to Coast Auto. So let's take a look at the chart. Here we go, all the way on the bottom. So we have transaction number 4. Cash in the bank. Is cash affected by this transaction? Not really, right? Cash isn't affected because we didn't pay for it in cash. So 0 in cash. Computer equipment. We didn't get any new computer equipment. Office equipment. No new office equipment. Delivery equipment, yes. Remember, we bought a delivery truck for $12,000. So that increases. Accounts payable. Do we now owe more money because of this transaction? Absolutely. So that would go up $12,000. And capital doesn't get changed because we don't have a claim to that asset. It's the bank that has a claim to that asset. So that would be 0. So if we bring down all the balances, we have $22,000 in cash still in the bank. Computer equipment worth $3,000. Office equipment that's worth $400. And delivery equipment that's worth $12,000. So these are all of our assets, right? All of our assets are listed there on the bottom. Now let's go to the other side of the equation. So they have to equal the total of these two here. So let's see. Accounts payable, we have $12,000 and we have $25,400 in owner's equity. So if we were to add these all up, if we add up all of our assets, they need to equal the total of $12,000 plus $25,400, right? So if we do that, we should be fine. We should end up with $37,400. $37,400 on this side. $37,400. on this side of the equation, and then we got 25, 37, 400 when we add up all of our assets, okay? So all of our assets add up equal to the same thing. We're imbalanced. All right? So this is a simple explanation or beginning to you guys starting to figure out how to analyze business transactions, record whether they're going up or down, making sure they're staying on the right side of the accounting equation, and then checking for the balances to make sure that they're equal. You would know you had something wrong if after every transaction you added up all your assets and saw if they were equal to the total of your liabilities plus the total of your owner's equity. Okay? This is chapter 3.2. In 3.3 we're going to talk about some more accounts dealing with revenue, expenses, and owner's withdrawals. So this should get you started. Play it back. If you have any questions, come and see me. I'll be able to help you out. Alright, so this completes chapter 3, part 2.